Welcome to the first module in HFA's Trustee Training course. The purpose of this talk will be to give you an overview of the medical schemes environment and introduce various concepts that you, as a trustee, will need to be familiar with in your role. They say that once you've worked in the medical schemes environment, it's in your blood forever. And that's certainly true for both you and me, Irene, who collectively have clocked up about 50 years in the industry. I'm Heidi Kruger, General Manager of the Health Funders Association, and I'm in discussion with Irene Zambelis, who's a stalwart of the industry and who brings a wealth of experience and expertise in all aspects of health funding and medical schemes. Medical schemes bear an enormous responsibility because they're often having to make decisions that affect people at their most vulnerable when they're ill. While they're representing the members of the scheme, a trustee must always act in the best interest of the scheme. Being properly informed about the industry, about the financial health of the scheme, and about the laws that govern medical schemes is what's going to give them peace of mind in this role. The medical schemes industry can be overwhelming for a new trustee. Medical schemes are finding it more and more difficult to keep contributions at an affordable level for several reasons, like aging membership, increase in utilization, and new technology. And with that, I'll hand over to you, Irene, to take us through the slides.
Thank you, Heidi. We do know that when we ask the question, what is a medical scheme? An ill event can occur at any time and at any cost. And if you choose to use private healthcare providers, it can be very expensive. A medical scheme provides cover for these expenses subject to terms and conditions. The challenge for the trustees is to provide the healthcare benefits their beneficiaries need at an affordable rate. By the end of the session, you'll have, amongst others, an understanding of the medical schemes environment, the difference between the open and restricted schemes, and the principles under which medical schemes are governed, and an idea of their cost drivers.
So what is a medical scheme, Irene?
Big question, Heidi. A medical scheme is a not-for-profit business entity. It is defined in the Medical Schemes Act as a body corporate capable of suing and being sued. The important thing is that each scheme has a set of scheme rules, and the scheme rules set out what contributions beneficiaries of the scheme must pay and what the benefits are that they will receive. And it's that the schemes will pay all or a portion of their healthcare costs. But whatever is provided for in the rules is guaranteed by the scheme. So this word guaranteed is important. The scheme cannot renege on that.
I think this slide gives us some interesting facts on the size of the industry. Take us through it, Irene.
So the size of the industry, I mean, the numbers speak for themselves. In the 2023 Council for Medical Schemes annual report, it sets out that the contributions paid by the members of the scheme came to 232 billion rand for the year. Just to put it into context, the public sector budgeted 272 billion rand for the 2024-25 year for about 50 million people, and the scheme has 9 million. The healthcare benefits that were paid for the year, which was paid from the 232 billion, came to 218 billion rand. So it really is a significant amount of money. And the question we need to always ask is, how well is that money spent? Out of the contributions received, 19 billion was spent on non-healthcare expenses, and this includes all the costs related to running the scheme, other than healthcare. The administration of the scheme takes the biggest slice of that pie. What is interesting to note is that the council in their report estimated the out-of-pocket expenses, which includes expenses from the medical savings account and paid out-of-pocket direct, incurred by the members, came to a whopping 43 billion rand. They do believe this is an underestimation because it doesn't include the out-of-pocket expenses incurred by members and that they don't submit to the scheme. So it's a significant amount of money that was paid. Schemes need to keep money in their reserves, that they cannot operate on an empty tank. So they do need to have money once all expenses are paid. And for all the schemes for the year of 2023, they had 109 billion rand in their reserves, which was calculated as a solvency ratio. The solvency ratio is what percentage of gross annual contributions is the reserves. And for 2023, it was sitting at 43.5%. They have made it a statutory requirement in the Medical Schemes Act that schemes must have a minimum of 25% in reserves. So that keeping more than 25% does not mean that the schemes are keeping too much. The actuarial evaluation determines what percentage schemes should keep in their reserves. So you'll find a lot of smaller schemes have higher solvencies, and some of the bigger schemes will operate closer to the regulatory requirement of 25%. I've added here the number of healthcare brokers. Healthcare brokers are financial advisors. They talk directly to clients and advise the client on the appropriate medical scheme to meet their needs and affordability. And we can see there nearly 8,000 individual brokers, and they are regulated by both the Council for Medical Schemes and the Financial Sector Conduct Authority. Now, we hear every year that contributions increase always more than normal inflation, which is why we get our normal inflation or CPI from Stats SA, and we can see it was significantly lower than the average contribution increase for 2025. We can see contributions increase between 8 to 14%. We get these increases in January of each year. And every year we say, why and how can we decrease this increase so it comes closer to CPI? We know that the main drivers of our contribution increases is inflation for medical supplies, and that's always the drugs, the healthcare services, but also an increase in the use of the service. And that is determined by how sick a person is and the age of the person. So the older we get, the more healthcare services we need. And also that we need to put something in the pot to build the reserves. And that is something that for trustees, managing your health risk is a very important part of your job. What we can see in this graph, and it's quite an interesting graph, it gives you the number of medical schemes for a 23-year trajectory. And what we can see, the green column, gives you the total number of medical schemes over the 23 years. And we can see a big reduction in the number of medical schemes. So there's 71 medical schemes in 2023. We can see the red bars give us the number of restricted or closed schemes. That sits at 55, and 16 schemes that are open schemes. We do expect a further reduction in medical schemes, the number of medical schemes. This consolidation will continue over time. We can see that they've given us this number of medical schemes by size. So if we look down below, they've defined, by they, the Council for Medical Schemes, they defined the size of medical schemes. They say that small medical schemes have less than 6,000 members. Medium schemes go between 6,000 members and 30,000 beneficiaries. Please note there's a difference between a member and a beneficiary. A member only includes the principal members that pay the contribution. Beneficiaries include the principal member and all their dependents. So between 6,000 members and 30,000 beneficiaries are your medium schemes, and your large schemes are schemes with greater than 30,000 beneficiaries. So if we look, we can see small schemes is what we've got the most of. About 30 of the 71 fall within the small scheme category. We then have about 20 medium, large schemes, and then the rest are medium schemes. It's important to think, why is the size of schemes important? You know, medical schemes give you cover for your healthcare expenses, where all the members' contributions go into one pot. And the more members you've got contributing to that pot, the better. So we call it the law of large numbers, and the bigger the pot, the more predictable it is. To the ability to predict your future claims experience is easier. So that is something that we need to think of. However, we mustn't think that the small schemes are not viable. There are many other factors that get taken into account other than size to determine the financial soundness and viability of a scheme. So Heidi, in this slide, we are looking a little bit more at open schemes and closed or restricted schemes. So open schemes may not deny anybody membership as long as you pay your contributions, you don't commit fraud. An open scheme must accept members, as opposed to the restricted schemes that may limit membership to an employer group or a profession. The importance here is that for a closed or restricted scheme, when it's a condition of employment that you belong to the scheme, you are joining the scheme because you are being employed, not because you've got a need to claim. As opposed to open schemes, where members may join the scheme when they have a need to claim, and then leave the scheme when that need is no longer there, which means they don't contribute to the pot. They only come in when they take money out the pot. And we call that behavior anti-selective behavior. And it does increase contributions. Each scheme has a number of options. Options have their own rules, contribution tables, and benefits. We find that open schemes have more options. We can see here 7, as opposed to 2 options per restricted scheme. So let's look at who governs medical schemes. And this is quite interesting because schemes fall under the Minister of Health and the Medical Schemes Act number 131 of 1998 and its regulations is the principal act governing medical schemes. And any policy doing the business of a medical scheme, and this business of a medical scheme has been defined in the Act. Those policies need to register with the Council for Medical Schemes as a medical scheme and comply with the Medical Schemes Act. So what makes a policy meeting the definition of the business of a medical scheme? They are all policies that are indemnity products. They pay claims at the actual cost of the ill event. There are still terms and conditions, but the cost of the event is largely covered by the medical scheme product. Medical schemes also may pay providers direct. And that makes a big difference, because if you have an unplanned hospital event, you go to the hospital, you say you've got medical scheme cover, and they will generally attend to you, as opposed to asking you for a deposit. So what changes have actually happened with the Medical Schemes Act? I said it was the Medical Schemes Act of 1998. So what happened before 1998? Medical schemes were allowed to base their contributions on your age and your and how high the risk was for you claiming. So they could say you're older, you're sicker, you will pay a higher contribution. And we call that risk rating. When the Medical Schemes Act came in, it introduced community rating, where your contributions are the same, irrespective of your age or health status. In addition, all open schemes must accept everyone, or the restricted schemes must accept everyone that's employed by a certain employer or part of a profession. And all medical schemes had to provide for a prescribed minimum benefit basket. None of this was in place before. Unfortunately, there are still some missing pieces of legislation. The medical scheme industry has been lobbying government to introduce mandatory membership, where it is mandated that all employed people earning above a certain income threshold must belong to a medical scheme. This would increase the number of young people joining and healthy. That hasn't taken place. And because the prescribed minimum benefits were introduced, that they would introduce a risk equalization mechanism for the prescribed minimum benefits, where schemes that were having a younger, healthier membership would assist schemes with an older, sicker membership, because the prescribed minimum benefits for schemes to cover this set of benefits. Heidi, with this slide, it looks at how many South Africans have medical scheme cover. And it takes us from the year 2000 to 2023. And what is interesting to note is from the year 2000 to about 2006, we can see that the medical scheme membership was sitting at under 7 million. We then saw an increase in membership because of the government employee medical schemes, GEMS, and for the last over a decade, we've seen that membership has plateaued. And that's because of affordability constraints and the constrained economy in South Africa. And what we can also see on this slide with age and pensioner ratios, that the memberships is aging over time. So what we can see here, the average age of schemes, of all the beneficiaries of schemes, all schemes, from 2009 was sitting at 31.6 years of age, and we can see that that has increased to 34 years of age. That difference of 3 odd years is significant in the increase in the number of claims that schemes experience. If we look at the line graph here, it looks at the percentage of members that are 65 years of age and older within schemes, and we call that the pensioner ratio. What we can see that the pensioner ratio has also increased over time. If we look at the next slide, this looks at the difference in age between open and restricted schemes. And what we can see that restricted schemes have had an older membership than your restricted schemes. And remember, I spoke about anti-selective behavior. So this is significant. If we then look at the prescribed minimum benefits relative to cost, and they bring in the age groups. So here we've got the cost of prescribed minimum benefits on the left axis per average beneficiary per month. And on the horizontal axis, we've got the different age groups starting at less than 1 year of age and going to 85 plus years of age. And if you look at the black solid line going across, this shows us the average cost per beneficiary per month of the prescribed minimum benefits, coming at 1,100 Rand per beneficiary per month. But what we can see, if we look at the different age groups, that your less than 1 year of age come above the average. And that's because of your premature babies. However, what we can then see, that the cost of providing PMBs dips below the average because the younger members claim less. And we can see to about 49 years of age. What we can see then as people get older, the cost for treating the PMBs escalates, and the orange line gives us the 2023 figures for PMBs. And what this then highlights, that the younger people coming below the black line cross-subsidize the older. And this is why it's so important that in a scheme's risk pool, they have more younger, healthier people to cross-subsidize the older. So the PMB conditions are 296 conditions that all schemes must pay by law in full from their risk pool. But most schemes provide for more benefits than the PMBs. So PMBs make up about half of the medical scheme benefits. And so if we're looking at all healthcare benefits, it comes to about 2,200 Rand per beneficiary per month. So if you think of the affordability for the average South African household to be able to provide medical scheme cover, it is quite a challenge. Which brings us to this slide, to benefit design. As a trustee, you want to know how rich can your benefits be? So if we look on the left, the right of the slide, not on the left. Let's start with the richer benefits. The more comprehensive the plans are, the higher the contribution. And what we can see is that the restricted schemes, about 50% of their schemes are comprehensive, and only 22% of the open schemes have comprehensive benefits. We can see as the benefits decrease, remember all schemes must make provision for prescribed minimum benefits. So that's the starting block. The partial cover plans sit in richness of benefits between a comprehensive plan and a hospital plan. The hospital plans are closer to PMBs only and have fewer non-PMB benefits. What we can see here is only 3% of restricted schemes are hospital plan, but 43% of open schemes are closer to hospital plans. Are we comfortable? With that?
Yes, it's interesting.
With any medical scheme, there's always a big need, Heidi, to give more. But there's a cost to giving more benefits and a balance with the affordability. And that is always the case. And with healthcare, it becomes emotional as well.
Yep.
So let's come to who governs medical schemes now and having to make these decisions. So we know medical schemes have members and their dependents. And members elect the trustees. Sorry, I was getting tongue-tied there. Nominate trustees to manage the scheme on their behalf. And this board of trustees takes the responsibility for managing, full responsibility for managing the scheme on behalf of their beneficiaries. And they must act in the best interests of the members at all times. The board of trustees is responsible for putting the scheme rules in place, which we know is the legal contract between the scheme and its members. Members have a responsibility to pay contributions and to familiarize themselves with the product they have bought. Because boards of trustees are non-executive directors of the scheme, they've been entrusted by members to manage the scheme. The trustees appoint a principal officer to manage the scheme on their behalf, as to oversee the running and operations of the scheme. The principal officer acts as the CEO of the scheme. But all decisions get made by the board. The board of trustees must decide if they're going to be self-administered to do the day-to-day running of the scheme, or if they're going to have a third-party administrator. They must also decide what managed care programs they're going to employ within the scheme for health risk management. And they may or may not have brokers Open schemes generally have brokers. Some very few restricted schemes have brokers because they don't need the marketing side. All of these expenses get taken from the contributions. These companies are all for profit and have to be managed. So there are contracts in place. Heidi, this is my last slide that I'm coming to. And it talks to the difference between medical schemes and health insurance products. And there's a dividing line between the two because they are different. Medical schemes are governed differently to health insurance products. And sometimes people confuse the two products. In 2017, the Minister of Finance published the demarcation regulations. And all products doing the business of a medical scheme, the indemnity products, fell under the Medical Schemes Act and its regulations. It's important because medical schemes can pay the providers direct, and they pay claims at the actual cost of the event. The health insurance do not link that. And with medical scheme cover, generally, you are not required to pay a deposit when you go to a hospital for healthcare, which is a big point. So now I'll hand over to you, Heidi. I've done a lot of the talking.
You have, and it's been interesting, Irene. Thank you so much for sharing your insights with us. It certainly is a complex environment that we find ourselves in. To the trustees out there, I hope you found this session useful and you now have a better idea of the industry and your role as a trustee. Please email either Irene or myself with any questions you have. And please look out for our next module, which will be on understanding the scheme financial statements. Until next time, goodbye.